You have all heard about the canary in the coal mine. Well, if not, back in my day, a coal miner would take a canary into the coal mine as an advanced warning sign. In a coal mine, a canary would die before the levels of methane gas or carbon monoxide gas reached the point where a human would die. So they called the warning signal the canary in a coal mine. And this is also a good metaphor for many things in life, including the stock market. And as you can see here, the canary is still alive. However, there are many signs in the stock market giving us a warning. So let's take a look. First, a little anecdote about Warren Buffett. And the largest distributor of wallboard in the United States is a company called USG. USG is pretty large. The company has been around for more than a century and generates billions of dollars in revenue. And it just so happens that none other than Warren Buffett's Berkshire Hathaway is the largest shareholder in USG. Buffett scooped up about 31% of the company during the financial crisis 10 years ago in a sweetheart deal that valued USG at less than $1 billion. Recently, USG agreed to a $7 billion takeover bid from another drywall manufacturer. Buffett's investment in USG will net around $2 billion, nearly 7 times his original investment 10 years ago. That's not a bad return. But here's the interesting thing. Warren Buffett is notorious for almost never selling anything. And one of his famous quotes is, "Our favorite holding period is forever." And it means that it's hard to find wonderful businesses that are selling at a discount, but when you do, you buy as much of them as possible and then enjoy the returns of that investment indefinitely. So, in other words, if you've acquired a fantastic, well-performing asset at a cheap price, why sell? And he practices what he preaches. Buffett rarely sells anything. And it was a big deal, for example, when he announced earlier this year that he had sold all of his IBM shares. That was a very rare move for Warren. And it's even more peculiar given how well USG has been performing. Revenue and operating cash flow have been growing steadily, and the U.S. housing market has been strong and is continued to stay strong. Maybe Buffett just didn't like the company or management, but who knows? And by itself, the sale of USG might not be a big deal. But remember, as we've talked before, Buffett's company reported a record cash balance in its annual report, a massive stockpile of $116 billion in cash at the end of 2017, most of it in short-term treasury bills. Moreover, Buffett reported that he hardly bought anything in 2017. Now, he's probably been buying Apple, as we've also discussed, but not much else. And one of his criteria is that the company or the stock has to be a sensible purchase price. And that last requirement here proved a barrier in virtually all deals reviewed in 2017. So Buffett's $116 billion mountain of cash was enough to literally buy any of the 450 largest companies in the United States. But he didn't buy a single one. Why? Because they're all too expensive. Asset prices are far too high. So here is the most successful investor in modern history who, one, didn't buy anything in 2017, continues to stockpile a mountain of cash, and is now selling an asset that he would typically hold forever because another company made an absurdly high offer for the business. Think about that. And then another story for you here. As you can see, this chart here is of the FANG stocks. In the last few years have been the so-called FANG stock phenomenon. Facebook, Amazon, Netflix, and Google or Alphabet have dominated the market. And as you can see, this chart here is kind of interesting. Google is the laggard, and the top performer is Netflix. And the so-called FANG phenomenon has dragged technology stocks to near dot-com peak levels relative to financials. And as you can see here, we're not far from the peak way back in the year 2000, just before the dot-com crash. And this FANG stock phenomenon has created a momentum, as always happens in late term cycles. It sparked the mom and pop retail buyers to chase the quick buck. And here's the interesting part of the story. While the average Joe is busy loading up on those hyper-valued tech stocks in his 401 and IRAs like never before, insiders at the FANG stocks have been selling their own shares at a record pace this year. Senior executives and directors of Facebook, Amazon, Netflix, and Google have dumped $4.58 billion of stock this year. That's according to data compiled by Bloomberg, and they're on track to exceed $5 billion for the first 6 months of 2018, the highest sales since Facebook went public in 2012. Think about that. How's your canary doing? So while you look at this chart here, which we've shown before, which indicates that smart money is bailing at rates not seen since the last recession, I'll tell you that the massive insider selling in the market-driven FANG stocks confirms the recent warning from the SEC commissioner about insider selling stocks into their company's buyback programs. The percentage of insider sales has more than doubled immediately following their company's buyback announcements, as many of the stocks popped. And daily stock sales by insiders rose from an average of $100,000 before a buyback announcement to $500,000 after the buyback announcements. And the sellers have received proceeds totaling $75 million more than they had sold before the announcement. And at 32% of the companies, at least one insider sold in the first 10 days after the buyback announcement. So you need to check to see if your canary needs some oxygen at this point, because the smart money is bolting for the exits. So for today, that's ChewDog Charts. Thank you.